The stock market rallied for the last 2 weeks. Here's a question for investors. Is this rally going to turn into the resumption of the previous 13-year bull market, or is it just a typical bear market rally, a head fake, or maybe even the beginning of a new bull market before it strips even more money out of the pockets of investors? Today we will examine this question. Hi, I'm Ben Reppond. Today is August 2nd, 2022. Welcome to my YouTube broadcast. I'm excited to bring this to you. We've got some good information. I think you'll like it. I'm going to begin with an interview with Barbara Ann Bernard. You may not have heard of her, but you will today. And she is a hedge fund manager. She runs her hedge fund out of Nassau, Bahamas, where she actually grew up. And she has a lot to say. She addresses this question. This is on Bloomberg. She addresses this question of, are we still in a bear market, and is this a bear market rally? Here she is.
Barbara Ann, can you just talk about what you make of this rally that we've seen so far in July, which might be the biggest going back to November of 2020?
Thanks for the opportunity, Lisa. Yeah, I think this is a bear market rally for sure, and it's based on hope, not on free cash flow, not on the free cash flow of the consumer, and not on the free cash flow of the corporate. When you have, what we're looking at is negative real wage growth, which is why we have the lowest consumer confidence in 40 years. And what businesses are facing is the highest PPI rates in 45 years, which is why small business confidence is at an all-time low. So these businesses are facing very little visibility over demand for their goods and the cost to produce them, which is not a healthy situation. And meanwhile, the market is rallying on, like we said, hope, not free cash flow. So I don't think it's sustainable, unfortunately.
Barbara Ann, let's go to the phrase that John Farrow hates the most, which is bad news is good news, which is what Jonathan Golub was talking about in his note today. That's what it's become. That the more people start to talk pessimistically the way that you do, they talk about possibly some sort of pivot from the Fed. Why is this not the right way to look at it, since it has been the right way to look at it for the past few decades?
Well, let's just break that down. Is bad news ever really good news? What you're talking about is the Fed will not raise rates. So we're talking about multiple expansion, not EPS expansion. And a healthy economy is based on EPS expansion. So yes, you don't want to fight the Fed, but we also want a healthy economy, don't we?
Well, in theory, Barbara Ann, yeah, I would assume so. But on the subject of the Fed and how they would likely view what we have seen in the equity market, a rally, financial conditions getting easier and not tighter, at what point will they have to push back on this?
Well, I feel like they induced this rally. It was the most confusing. Either I was on the wrong call or I misunderstood the market. But what I heard was there's no more guidance because we're tired of being wrong. And then number one, our goal is to bring down inflation for a soft landing. But number two, we understand that's challenging, and it's got more challenging in the recent months. None of that's positive to me. And then I think the real error was calling 2.25 to 2.5 a neutral rate. In my economics textbooks, that's not the case, particularly not when inflation's at 9%. So that is very stimulative and accommodative, and that's what's fueling these forces that at the same time he's trying to squash. So he also said the dot plot is the best indicator. Well, what does the dot plot say? That we have 100 basis points of more increases this year and 50 next year. So rates are still rising, and we have consumer and business confidence falling. We've never raised rates into falling confidence. And the other really interesting experiment is we've never raised rates when the U.S. Fed debt to GDP ratios are so high. So if we do induce a recession, the real risk out there is now you have lower tax receipts and higher interest expense, which is also not a pretty picture. So this is not easy. And I think as an active manager, what you want to do is really stay nimble and humble, because we're now told we're going to focus on data, which is going to be much more volatile.
Okay, so she is talking about the market is moving up on hope, not increasing free cash flow. Increasing free cash flow would definitely be an indication that we have a strengthening market, not just let's go along with the crowd. She talks about negative real wage growth. Wages are growing, but inflation's faster, so people are actually earning less and less money, no matter what they get most of the time in increased earnings. They lose money because inflation is stripping it away. Lower consumer confidence and small business confidence is at an all-time low. These are not indications of a new bull market or the resumption of the previous bull market. I put this slide up to show you that it's 2007 to 2009. The heart of it is 2008. During that period of time, we remember that was certainly a bear market. The S&P 500 went down 56%, but it did not go straight down. It went down sort of in waves. That's the way I think of it. It goes down, and then it catches its breath and tries to go back up again. And it goes through that. This documents the 10 times in that period of time where it tried to go back up, but it failed. It failed because the market conditions were actually bearish conditions. And so you can see, and it documents the percentage that it gained, and it documents the period of time, the number of days that it tried to go back up. We'll call those bear market rallies, 10 of them, before it finally collapsed at the end in March of 2009. So here we are today, the 2nd of August. As I look back to the beginning of this year, we had a little bit of a rally, an attempt at a rally in March, and in July we've had one, very similar to this. So where it attempts to go up, and then it just collapses. So Barbara Ann Bernard has stated that this is clearly just a bear market rally. It's not something to get excited about that we're in the next bull market, although I wish it were. I would hope that we're going up from here, because that's how you make money. That's how we make money. And that's how we make money for our clients. And so, but I think it's temporary. I think it's a short term. What we have done is we invest tactically. We do not invest in a buy and hold portfolio. We do not use bonds, and we do not use that approach. I think this year has shown investors that it is a failed approach. It's not effective. And there are probably variations of it. There certainly are variations of it where advisors have been able to, or investors have been able to maneuver with it. And anyone who has had a moderate degree of success during this market, I would give them a lot of credit, because it's been a very difficult market. We have been out of the market a lot of this year. We re-entered 2 weeks ago for a few days, made some money, got back out, and then this past week we entered the market again and are still in the market, and have been, I think, in the market 3 days now, made some attractive gains, but we are prepared to get back out of the market when the market turns back down. And as Barbara Ann Bernard said, she believes this is a bear market rally. It'll go on for a while, and then it will fail, it'll collapse. So we're prepared for that and have adjusted our model so that we're quite sensitive to when the market starts to turn. As we go through cycles in the stock market, the market goes up and the market goes down. This is a slide that portrays the emotions that go with that. We're all emotional beings, so we're affected by this. So if we have money, the more money you have, probably the more you're affected by it. And if you're in retirement, you're affected by it because your accumulation years are behind you. You have what you have, and you want to preserve it. So loss of that money is a big deal. And so what that does is that our emotions are affected by that. So the market goes up, and this on the left side of the slide, this portrays this well. These are emotions of optimism, excitement, thrill, euphoria, kind of increasing positive emotions as you get closer to the top. What's interesting about investors in particular, I don't think so much advisors, but more individual investors, is that sometimes it's easy to get caught in the first part of this cycle, the left side, where you're in this optimism, excitement, thrill, euphoria, and then you're validated by it because it keeps on going up. Wow, I'm really smart. And then it doesn't. And then it turns, and you see the second part of this cycle, beginning with anxiety, denial, fear, panic, capitulation, and desperation. And maybe even somewhere at the bottom, depression. Just, I'm done. I don't ever want to invest in the stock market. Don't ever talk to me about the stock market, etc. But that's how it goes. Now, interesting, when you see this this chart, this is the way kind of the stock market goes, because it goes up kind of gradually, but when it collapses, look at the second part of that cycle, it just collapses. And it goes down much faster than it goes up. And then as it hits the bottom, it gradually comes back, and then you get into the other end of the cycle, which is hope, relief, and then you're back to optimism, and the cycle repeats itself. So, but what happens at the very bottom is it wrings a lot of emotion and just a lot of emotion out of people, and they become very anti-stock market, kind of depressed about it. And I've talked to a lot of people who call me and have these conversations, and some people have really been who counting on their money, and their advisors have invested in a certain way, and they've lost a lot. I talk to people all the time who have lost 20, 25, even 30% or more of their money. Sometimes these are sizable amounts of money, and people are counting on this because they're either in retirement or they're approaching retirement. A very difficult circumstance. So when I hear that, I certainly empathize with their feelings of frustration and sometimes actually anger. And but these are the cycles. And so when a person takes the market kind of in their own hands, and sometimes advisors do this too, and they don't really know what to do. They're about reading something out of a textbook, or they, heard it from somebody who's an investor. This is the way to do it. It doesn't work that way. There are some reasons why that I think Barbara Ann's comments are particularly insightful and correct. There are not yet optimistic signs in the economy in general. There may be with this company or that company, but in general, there are many headwinds to the stock that are affecting the stock market and the bond market. And this is related to country debt. Now, I apologize for it being so small. So if you put a comment in the box about that, I understand. I couldn't make it larger. But I highlighted 3 areas to just show the amount of debt. And the amount of debt is just increasing and increasing. And every country is like this. I found a few that are not, that don't have any debt. Brunei and countries like this, they're not really significant players, but the more significant, and Macau, countries that are more, that are larger, that are more influential in the world economy, and even some that are lesser countries, all are taking on debt, all have taken on debt. And this shows, in the next to the last column, the percentage of the total debt. Now, the total debt is the government, and I think that means national, local, state governments, and personal debt and corporate debt. So all debt. Looking at the Eurozone, Japan, and the US. These are three that stood out. So looking at the Eurozone, and this is the percentage of debt to GDP, gross domestic product, which is a measure. That way you kind of deal with, okay, we're taking on so much debt, and how much economy do we have to support that debt? It's a fair way to look at the amount of debt. Otherwise, it's just a raw number and it doesn't mean much. The Eurozone, 64 trillion, and over 400% of their economic output, their gross domestic product. Japan, over 700%. When you get above 100%, it starts to be trouble. Japan, 700%. And the US, over 300%. Nearly, I think all of them, or nearly all of them, are well above 200, and most are above 300% debt to their economic output, gross domestic product. So I think of it like this. If you see something that you want to buy and it's expensive, then you are married and you say to your spouse, I'd like to buy this. Why don't we buy this? And your spouse says, well, we can't afford that. Really? Yeah, we cannot afford it because we would have to take money out of savings or we would have to make payments. And based on our income and our assets, we just can't afford it. And you go, okay, we can't afford it. Now, if you're single, you're not married, you'd have this conversation with yourself. Can I afford it? And really, realistically, can I afford it? Do I have the assets and income to afford it? If the answer is no, then you don't buy it. Usually, you don't buy it. If you're foolish, you would buy it, but most people are not. But when governments encounter this, I want to buy this, I want to invest in this, I want to have this program or this initiative or whatever it is, and it's in the millions and it's in the billions and it's sometimes even in the trillions of dollars. Do you ever hear this phrase, we can't afford it? Have you ever seen that written about or reported or congressional hearings? We can't afford it? Never. The country just says, okay, let's just spend it. They have no idea. They have no plan to ever pay it back. Ever, ever, ever. Not a penny. You don't ever hear them talking about let's pay off some debt. They never have a plan to pay off $1 of interest. And with increasing interest rates, that should be a very significant conversation. They're not the least bit concerned, and it's not just the US, it's every country or virtually every country in the world. We can't afford it. Why don't we have that conversation? What if somebody ran for office, for any office, on the platform of let's eliminate our debt? Or how about let's start paying the interest on our debt? Let's start not borrowing any more money. That would be huge. Nobody in either party runs on that idea. If you know of one, let me know, but I don't know of any. And if they do, they probably won't be elected. Reminds me of the saying by Jean-Claude Trichet in Europe. I think he was the Prime Minister of Luxembourg and on the European Council, President of the European Council, and he said, we all know what to do, we just don't know how to get reelected when we do it. At least he's honest. Okay, the second headwind is, this is a flow of funds report. This is as of July 27th. It comes out every week to show where the money is moving to and from. And is money coming into the market or is money going out of the market? So even though the stock market went up in July, and it particularly went up in the last 2 weeks of July, look at the last week measured July 27th for the previous 7 days. equity fund outflows of 5.2 billion, money going out of the market. Taxable bond outflows, 3.8 billion. So money is leaving the market quietly while people are investing more money. And as Barbara Ann Bernard said, hope, not free cash flow. You run your household budget. I ran a company in Seattle, and I understand free cash flow. If you don't have free cash flow, you either bring in an investor or you take on debt or you cut expenses. Those are your options. And so she's saying we don't have free cash flow. We certainly don't have increasing free cash flow that is compelling the investors to come into the market. And the third area is with rising interest rates, this is impacting home sales and it's impacting mortgages. Got this data on mortgage applications down 59.8% year over year, reaching a 22-year low. Refinance activity, which that was going very strong last year, is down 83%. At some point, the refinance activity is going to go to zero. And I don't know why someone would refinance now, but this is the data that I got. So what does that do? That impacts the sale of homes, because a lot of people are not cash buyers. They require a mortgage. And if you've got this kind of reduced activity, why? Higher interest rates. So the price of homes is up and the price or the cost of a mortgage is up. So it's costing more and more money. I would say, if anyone asked me, I would say, if you're thinking of buying something, particularly using a mortgage, I would say, wait. Buying might be a good idea, but wait. Wait until prices become much more attractive, and maybe when interest rates become more attractive. Most of you know of Cathie Wood. Cathie Wood is the CEO and founder of the ARC Innovation Funds. There are several funds. I believe there are 5 of them. And she founded them. They're the innovator funds, generally small cap companies, but with innovation technologies. And she is well thought of. I respect her a lot. She is a person of deep character, and her funds have been down this year a lot. And if you track them, you know what I'm talking about. I believe at one point the ARC fund, ARC-K fund, which is kind of the leading fund, technology firm fund, was down 75% from January 1. So it's been a hard year, but she owns the space of innovation in the investment world and has a lot to say. I respect her, and I want to play this clip, and she's going to talk about the market conditions and what she sees as the cause of that.
She's been a longtime bull on growth names, loading up on shares of beaten down pandemic darlings while the rest of Wall Street contemplates their prospects. And the earnings season so far has been punishing to some of her biggest holdings, like Roku today, down 23%. Joining us now, ARK Invest, Cathie Wood. Cathie, thank you so much for spending your time with us on a Friday evening. Now, is there anything so far in the earnings season or the economic data, anything else that would make you waver in your conviction of the growth trade?
Well, what we do see in these earnings results is that we are in a recession. And we've been calling for a recession for quite some time, a lot of it based on excess inventory. So we think this is an inventory-led recession. And I think that's coming through loud and clear. We're seeing advertisers cut back dramatically. It seems like when Walmart and Target announced in May that they were loaded up with inventories, and this was far above what they had expected, and that they were going to have to do something about it. You know, a lot of advertisers started cutting budgets, saying, okay, this is a possible recession indicator. And as you know, We've just gotten 2 quarters, consecutive quarters of negative real GDP growth, but a lot of people still are fighting the notion that we're in a recession.
Yeah, certain people are fighting that notion. A lot of economists like yourself, there is a technical recession, but then there's also what a lot of folks, including Fed Chair Jay Powell, says isn't necessarily a recession. They define it as a broad-based slowdown across a number of industries. Are you seeing that?
I think this is a recession. And I think what the Fed is really focused on is employment as a gauge. Employment is a lagging indicator. The CPI, the PPI, all of those are lagging indicators. If you look at initial unemployment insurance claims, they're up 50% from the low. So I do believe we're going to see some significant disappointment in the employment numbers moving ahead. And I also think, based on what we're seeing from gold, the gold price actually peaked in August of 2020. Many people don't know that. And it's down near the low end of a range, a 2-year range. That's an important inflation gauge. And then copper price. The copper price broke down. It broke a 1-year trading range in the $4 to $5 per pound range, and it has come down hard. So I think all of these are signals that that inflation is going to come down. It's going to come down significantly, and that we're probably going to see some deflation. And we've been calling for that for quite some time as well.
So she's talking about an inventory-led recession. Have you ever heard of that? I haven't heard of that. I thought that was interesting. And she cites the data to support the fact that it's inventory-led. And that inflation is going to probably go into deflation. Now, we have not seen deflation probably in our lifetimes, anything of any significance of deflation. And that's when asset prices actually become deflated. And because we have this overactive Fed that loves to print money or release money digitally into the system, and that's kind of their antidote to all of our problems. Of course, we have tons of money in circulation. We have over 21 trillion in circulation. They have over 9 trillion on their balance sheet. So the idea that we can just print more money or they can buy more assets is it's been an interesting solution to a problem, but that is not going to last forever. And at some point, we will go into deflation, as Cathie Wood points out. And she says we have a ways to go before we hit bottom. And the investment managers that I follow, every one of them is saying we have not hit the bottom. And there's another leg down. There may be another 2 or 3 legs down. We don't know. But we have not hit the bottom. I do not know a single manager that says we're ready for a new bull market or we're in a new bull market. And until we do that, stocks cannot really genuinely rally. We saw the cycles, the emotion cycles going into capitulation and devastation, where people literally get wiped out. This is the reason why that I believe in investing tactically, getting out of the market as much as I know how, mathematically, when the market is in a period of decline, and getting back into the market when there are periods of growth. Even if they are short-term growth, there's a short-term opportunity to make money. We want to be in and take advantage of that as much as possible. And then when we hit the bottom, the emotions of people, when the market hits the bottom and actually capitulates and wipes out a lot of people in its path, people are not emotionally ready to invest in the market. And a lot of times, if they follow traditional investment advisors, they don't have the money to invest. They've been wiped out. But if they have money to invest, it is very difficult for people to pull the trigger and to get back into the market at the time where the opportunity is highest to make money. This chart goes back to 1775. So this is 247 years of data. It shows two things. The red spikes up and the blue spikes down. What are they? The red spikes up are periods of inflation, and the blue spikes down are periods of deflation. So you can see, when you look at the macro chart, you can see these periods of time. If we were to look at 1913, when the Fed came into existence, I didn't mark it, but I have the black arrow and the red arrow. Just to the left of that black arrow was when that's 1919 to 21, where that black arrow is. So just a few years before that is when the Fed came into existence. And maybe it's right before that big red spike. And so, but during the late 1919 to 1921, 1920, 21, somewhere in there, that was following World War I. And that was definitely a period where the stock market crashed, and it was a period of deflation. All asset prices were being deflated, or most of them deflated. And so even though the Fed was in existence, I don't think they'd yet figured out how to print money like they figured out today. But anyway, it took the economy down. And then, of course, the Great Depression, marked by the red arrow. And we all know that asset prices clearly, even with the presence of the Fed, they clearly went down. Of course, again, I think if the Fed had caught on to the idea of printing money like they do today, they would have thought, okay, we can prop this up. I'm just thinking that is a speculation. But anyway, those are the two periods. Other than that, there are no significant periods of deflation since the Great Depression. We have done nothing but print money. And we've got, as I said, 21 trillion in circulation, and we have about 9 trillion on the balance sheet of the Fed. So printing money is the order of the day. But it's interesting to note the chart ends in 2015, so it's not a current chart, and you can see it begins by trailing off. So I don't know if Cathie Wood is looking at this for her speculation. But, the one thing I do want to point out is that with current inflation, let's say using the government numbers of 9% or so, there would be a spike up at the very end if we were to include the current year up to that second line. But eventually, the piper has got to get paid. And eventually, this inflation, there needs to be some air come out of the balloon. I don't know if we're going to end in deflation. It would be healthy economically, but it would certainly wipe out a lot of people. But that's her speculation. She says, and if that happens, and when that happens, then we are prepared to grow. We can truly grow once that you wring out that excess out of the system. That's my version of what she's saying. When you think of inflation, this was an interesting chart because the top bar, this shows the periods of time where there has been high inflation and low inflation. Paul Volcker, the chairman of the Fed in the late 70s and 1980s, was very determined to bring down inflation, and he believed in a strong dollar policy. And he was willing to crash the economy, which he did, in the late 70s and early 80s. Definitely the market, stock market and bond market crashed. But he saw that dealing with inflation, bringing it down sharply and getting it under control was essential. So here it is, the long blue line at the top of the chart, 13.5% inflation. 13.5%. And back then they were using real numbers. They were not involved with the substitution and the manipulation that they do today. That was the true number was 13.5%. And 3 years later, by the black arrow, he brought inflation with rate increases and a crashed economy, crashed stock market, crashed real estate, crashed everything, brought it all the way down to 3.2% in 3 years. So if the Fed talks about getting it under control and bringing it down, It can be done, but Chairman Powell is tiptoeing into this equation, and he and his predecessors all look way too political for me. Chairman Paul Volcker was a straight talker, a no-nonsense guy, and he got it done. But I can't think of any Fed chair after that time that has been willing to take the heat, the political heat, that is necessary to get it under control. They may talk about this. I don't see this happening. My 2 cents worth. Now I want to play a piece from Neel Kashkari. He is the Fed is made up of regional Fed offices around the country. He's the president of the Minneapolis Fed, one of those offices. And I like him. He is very straight talk, no nonsense. He's not the vice chair of the Fed, so I don't know if he's in line for being the next Fed chair. But if he could talk this straight as the president of a regional Fed office, he would be the kind of a Fed chair that I would like to see there. But I don't know that would happen because, again, I think it's too political and they don't want someone with straight talk like this. Here's Neel Kashkari.
We turn now to the president of the Minneapolis Federal Reserve, Neel Kashkari. Good morning, Neel. Inflation.
Good morning, John. Thanks for having me.
Thank you for being here. Okay, everybody wants to know, inflation still hot? What does it look like to you?
It's very concerning. You know, we keep getting inflation readings, new data that comes in as recently as this past week, and we keep getting surprised. It's higher than we expect, and it's not just a few categories. It's spreading out more broadly across the economy, and that's why the Federal Reserve is acting with such urgency to get it under control and bring it back down.
Wages within that, what does the wage picture look like in the 2 different ways we measure it, both just on its own and then relative to inflation?
For most Americans, their wages are going up, but they're not going up as fast as inflation. So most Americans' real wages, real incomes are going down. That's why families are finding it increasingly hard to make ends meet. When they go to the grocery store, when they buy necessities, they're not able to buy as much because they're getting a real wage cut because inflation is growing so quickly. I mean, typically we think about wage-driven inflation, where wages grow quickly and then that leads to higher prices in a self-fulfilling spiral. That is not yet happening. High prices and wages are now trying to catch up to those high prices. Those high prices are being driven by supply chains and the war in Ukraine, among other factors. And so we need to get the economy back into balance before this really does become a wage-driven inflation story.
I'm going into the dashboards and the summary of the stock market, what's going on in different components, and then I've got a surprise for you at the end. I think you'll like it. This shows I looked at the far right column, the rate, the amount of decrease in each of these indexes or stocks since the beginning of the year. So this, again, things have improved, and we're going to see some data that shows that they've improved. So this is not as bad as it was a few weeks ago and certainly a month ago. The Dow is down 9.5%. The S&P 500 down 13%. The NASDAQ 100 was down over 30, and now it's down 20%. TLT, the 20-year government long bond, still down over 20%. This is a culprit. This is a problem. This is damaging, or other bond funds or bonds similarly are dragging down the stock market, and they may go down as much as the market or more or less, but they're not going in a counter direction to the market to be the antidote to stock risk. And the long bond, government bond, is what has typically performed the best in favorable market conditions, and here it has performed the worst. So an indication of the depth of the problem that exist in the market still, even after a favorable July. NDXT, the NASDAQ 100 technology sector, the technology sector of the NASDAQ 100, down 26%. And I've talked about Cathie Wood and her ARK funds. Her ARK-K fund is still down 52%. It was down as much as 75%. And Netflix is down 62%, and Coinbase down 75%. Coinbase has still not recovered much. This dashboard shows the major indexes, and the dots on the far right side show the status of these indexes relative to their moving averages. For example, going left to right, the four moving averages are the 20, 50, 100, and 200-day moving averages. When there is a green dot, it indicates that that index is above that moving average. That is a favorable indicator. That's why I give it a green dot. If it is still below that moving average, it gets a red dot. This has been improving because we had a few weeks ago, you may remember this if you watch, we had a chart where they were all red. I think it was at the end of June. They were all red. There are 36 of them. 36 out of 36 were red. Since that time, we've gradually been improving. Last week, there were 13 green dots. This year, there are 20. So I won't go through each of these, but if you want to study this year, well, you certainly should pause it and take a look for yourself. But you can see all of them have gotten above their 20-day, most of them above their 50-day, and some even above their 100-day moving averages, showing an improving condition to the market. This S&P 500 is made up of 11 sectors from different components of the economy, and each of those sectors has its own moving average, and that's represented by exchange-traded funds. The symbol of the fund is in the far left column, and the 20, 50, 100, and 200-day moving averages are on the far right. The ones that have done the best, that are above all four moving averages, are defensive sectors: energy, healthcare, and consumer staples. Above all four. Very impressive. And the others are above, some. Telecommunications isn't above any. It's still below all four moving averages, but the others are above one or more of the moving averages. And that is 28 green dots out of a potential of 44. More than half have moved into positive territory relative to those moving averages. Okay, I'm moving over to charts. This is a chart, a weekly chart, showing one move. One move in this line represents 1 week of change from beginning to end of that week, 1 week of change of the S&P 500. And then there is the blue line that cuts through the data, and it is the 20-period moving average. The black line, the black arrow, indicates the direction of the S&P 500 from late December to today. You can see that the black line through that period of time, which I'll call an intermediate period of time, is still in a downward direction. We're still in, as Barbara and Bernard said, we're still in a bear market. And that black line indicates that we're in a bear market. I circled at the end of the chart the data for the past few weeks to show you the increase in value in the S&P 500. So we have a short-term, the last month, a short-term upward move in the S&P 500, and it's even crossed above its 20-period moving average, indicating that it looks like we will have some kind of a short-term bear market rally again, that it has moved up. It needed to blow off some steam to kind of catch its breath, whatever term you want to use. but it is still in a long-term downward trajectory. This is a relative chart that shows the relativity between the growth component of the S&P 500, those stocks that are growth stocks, relative to those stocks that are value stocks. So it's a ratio, growth numerator, value denominator. So if it is moving in an upward direction, that is going to favor growth. It is moving in a downward direction, that is going to favor value. So you can see the long-term trajectory over a 12-month period. This looks like about 7 or 8 months, probably 8 months, that value has been in favor, represented by the black arrow moving in a downward direction. Again, you can see at the very end of this chart that the growth component of the S&P 500, those growth stocks, have begun to outperform the value stocks, and it has moved in an upward direction. As I said, we've been invested most of the time in the last couple of weeks, a good portion of the time, and we don't just invest in the market, we invest in the index that is doing the best at that time, and we have a mathematical equation that tells us that as early as possible. So as soon as we came into the market, the first thing we did was we invested in growth stocks or growth indexes, which is the NASDAQ 100, and are still in that index because it is still outperforming. Because when it outperforms, it tends to continue to outperform for a while. When that changes, flips and goes into value, which it can and it will, then we will change our direction and go more into value stocks. Now we do another ratio. This is a 24-month chart, not a 12-month chart. And we do the ratio between the small cap index, the Russell 2000, represented by the exchange traded fund IWM as a numerator, and SPY, the S&P 500, as the denominator. And what this means is that if the market is moving in an upward direction, that the small cap index is in favor. It is outperforming the large cap index, which would be the S&P 500, represented by the 500 largest companies on the stock exchange. So now you can see, because I circled it in black at the lower right part of the chart, you can see that the Russell 2000, the small cap index, has stabilized and is either going up or down at a similar rate to the S&P 500, maybe even increasing in value a little bit more so than the S&P 500. This is a positive sign because it's been going down for a long time. Still a 24-month chart, but it's not a relative chart. This is a chart unto itself, the long-term government bond exchange traded fund, TLT. Now, I covered this earlier in the dashboards. You could see that. So now here's the chart of the long-term government bond, TLT. 2 periods of time in the last 24 months that government bonds, and this is the long-term government bonds, they've all done this. TLT just does it more because it's a long-term bond versus an intermediate or a short-term bond. But they all move approximately in the same direction at the same time. So 2 black arrows, and you can see the direction, not compared to anything. And this is trouble for traditional stock and bond portfolios. Not good. So if you're in a portfolio and it's not doing well, and it probably has bonds in it, this is one of the culprits. In addition to the stock risk, there is now bond risk. I've got this slide out of order, but I did it because I want to make a point. This is the value for the last week, the change in value in gold and silver. Gold has been decreasing in value for a while. And last week, it was a good week. It went up 2.3%. The silver went up 9.5% in 1 week, but it was also down the most. So with that context, I'll show you the next 3 slides. This is the slide of gold. Now you can see what happens with gold. This is over a 24-month period of time, going back to the very top of the chart on the far left. That was the high for gold in the last couple of years. But you can see it goes up and down a lot. That's just what's happened. And then toward the end of the chart, it went down. And I have a theory on why it went down, but it's just a theory. At the very end, remember I just said gold went up this last week 2.5%. That's a lot. So you can see that move up at the very end on the far lower right of the chart is moved up. Is that going to result in an upward trend? We don't know that yet, but it has certainly been positive for precious metals this past week. Silver, this is an 18-month chart. The long-term trajectory of silver is down. Look at the very far right corner and you can see the degree of increase. That is a 9.5% increase in 1 week. When I compare on a 24-month chart, I compare gold to silver, silver being the numerator, gold being denominator. So when it goes up, this means that silver is in favor. When it goes down, gold is in favor. You can see that spike up at the very end. That's the relativity of silver versus gold. Silver went up 9.5, gold went up 2.5. So silver way outperformed gold, but it also, when it was going down, silver was going down faster than gold. So still on a relative chart, silver is still clearly, for the intermediate term, for looks like almost 18 months, is still out of favor. But a good week for silver. Volatility index. This is a 12-month chart. Now remember, I've talked about the idea that the artificial line, the black line, is marked at 24. Somewhere in the mid-20s, people agree that when volatility gets above that number, it could be 25, maybe even 26. 24 is talked about a lot as a level where if volatility goes below that, it is favorable for equity investing conditions. And if it's above that, risk has entered the market. So we have crossed through that 24 level, and we're now in a downward trajectory, which means it's positive environment for equities in general. Asbury Research, they do indicators, and this is a metrics that they do of 6 different market indicators, and these, all 6 of their indicators are positive. We've talked about in the short run especially that the positive conditions for equity investing over the past month or so, and this is certainly reflecting that, to say particularly for the last part of July, that all 6 of their indicators have turned positive. This is a cross-asset relative performance chart comparing assets or indexes one to another, which is more in favor than the other. Going from left to right on the last 3 columns, you can see the weekly, the monthly, and the quarterly view. So it's helpful to see all of them, the very short term, then a month out, and then 3 months out. So still relatively short term, but it shows the direction of the market. So when they put them in green, that shows that there is enough of a relative performance of one versus another that it merits a green box. For example, going through this, stocks are more in favor than bonds. High beta, a little more volatility stocks. We covered that before with the growth stocks. High beta is more in favor than low beta. S&P 500, more in favor than the Dow. That would say the S&P 500 is a broad index, including growth and value, and the Dow is more value oriented. And we've seen that in our growth value comparison. S&P 500 is stronger. The NASDAQ 100, when compared to the S&P 500, is in favor in all time periods. We saw that also. Growth over value. NASDAQ over S&P. Same thing in the next one is growth versus value. And then U.S. versus the developed markets and the emerging markets. In all three time periods, the U.S. is in favor. If you go back a period of time, a few months, you may remember it was a different picture. In the bond area, corporate bonds are down, but they're down less than government bonds. Okay, that covers the relative performance and the U.S. versus the world. Don't think we've seen a chart like this where there are no green boxes. The U.S. is in favor, but barely in favor. So if it's barely in favor, it's not enough to even get a green box. You can see that there are some countries that are emerging that I'd say, France and Brazil are emerging, but beyond that, really not much, not enough to really indicate anything. There are 21 countries and 3 regions of the world. None of them are much ahead of the U.S. or the U.S. is much ahead of them, or enough so to merit a green box. Okay, I want to cover something. I had a couple of people comment that the people I've illustrated, Warren Buffett and Ray Dalio and Jeremy Grantham, etc., are all men. And in most cases, these guys are old guys. And Ben, why don't you cover some women? Did you notice today that I covered women? I covered Cathie Wood, and I covered Barbara Ann Bernard. Have you heard of Barbara Ann Bernard? Maybe not. She's a hedge fund manager in the Bahamas. But Cathie Wood is an amazing person. I respect her. After reading about Barbara Ann Bernard, I respect her equally as much in a different kind of way. She's not only accomplished a lot and is very smart about investing and has some interesting insights, but her personal life shows a depth of character that is uncommon and puts her in a special category, not just as a woman alongside of Cathie Wood, but an amazing individual. And I want to explain why. You see, Barbara Ann Bernard is a triathlete. And she's not just a triathlete. She is a triathlete who runs and swims and cycles, pulling or pushing her cousin who is disabled. Her cousin has cerebral palsy and multiple sclerosis, a double disability. And they run races together all over the world, triathlons. So can you imagine Barbara Ann Bernard cycling 112 miles? And these races oftentimes include some challenging hills. And she's pulling her cousin. Or if she's running a marathon inside of that triathlon. She's running 26.4 miles, pushing her cousin. And when she's swimming in the open ocean, 2.4 miles, pulling her cousin in an inflatable life raft. Can you swim 100 yards? A couple of 100 yards? How far can you swim? What if you had to pull another person in a life raft 2.4 miles in the open ocean. I'll be honest with you, I can't even fathom this. And all of this is not spread over 3 days. This all happens consecutively. You finish one, you do another one. And that's who Barbara Ann Bernard is. So when I learned this about her and saw this about her life, she's not only a woman of accomplishment and very smart in the financial field, she's a person that has a depth of character and would do something like this. I don't even know how this is possible, but it says a lot about her. So in the future, you're going to see a lot more from women, and you're going to see a lot more from Barbara Ann Bernard, because I'm going to look for it. So I hope you've enjoyed this. If you have comments, please leave them in the comment section below. If you want to reach out to me, I always appreciate people who do. Feel free to give me a call or send me an email. I'd love to respond to you. Thank you again for watching.